Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology and financial advice. Hosted by Abraham Okusanya, you can expect raw honesty, critical analysis and energetic interviews. Here is your host, Abraham Okusanya.
Hello again and welcome to Retirementals. My guest today will be known to many of you. Robin Powell is an award-winning journalist and campaigner for positive change on investing, an advocate for evidence-based investing, and is the director of Ember Regis Group, which includes, you guys will be familiar with Ember Television and Regis Media in the business of providing marketing content for financial advisors. And of course, Robin is popularly known on social media and Twitter and LinkedIn for winding up asset managers. Robin, welcome to Retirementals.
Thank you very much. Well, I hope I don't wind people up too much. I've learned to be a little bit more, shall we say, gentle and emotionally intelligent as I get older, Abraham. So I try not to get into any squabbles nowadays.
Oh God, it's the squabbles that I like. People don't like the truth, and when you're a truth teller, which is how I think of you, you get a lot of comments and challenges on Twitter, or LinkedIn, on social media, which aren't always always positive, but it comes with the territory. Anyway, Robin, welcome to the podcast. It's really great to have you.
Thank you. And it's a pleasure to be here. And thank you for inviting me. As you know, Abraham, I'm a big fan of you and what you've been doing in the industry over the years.
So thank you. So we want to have a wide range of conversation today. Again, focusing on, we're going to talk about your new book that's just come, that's just been published. Congratulations, by the way. I've been told, it's a labor of love, writing a book and publishing it and putting it out there. A lot of work goes into that, doesn't it?
Yeah. You certainly don't do it for the money, Abraham, writing a book.
Yeah, I don't know. I mean, this is the thing, when people said this to me, I published my book a couple of years ago, about 3 years ago now. And still till today, I get about £150 every month put into my account, from Amazon. And I went back over the last 3 years and I looked at the total, right? Because there was a lot in the early days. And I looked at the total. It was well over, £10,000, right? So I'm sure yours will do much better than
Oh, I don't know about that.
Anyway, so look, before we dive into the book and we talk about the book, let's start off. Give us an insight into your career and the journey that led to, the work that you do in the profession today.
So very briefly, I'm a journalist and still very much consider myself as a journalist. I worked in newspapers, albeit briefly, in radio, again briefly. Most of my career was actually in broadcast television. With ITV, Sky, BBC, politics show, and so on. And to be honest, I didn't really have any particular interest in finance. I must say, for many years, I religiously read the money section in the Sunday Times and lost quite a lot of money following some of the tips in there over the years. Thought I knew, and I think this actually applies to a lot of people, thought I was being canny, thought I knew far more about investing than I actually did. You come to a stage in your career as a television journalist that you you're competing with much, shall we say, much younger, much better looking people than yourself. I sort of saw the writing on the wall and got out about 10 years ago now, and set up my own production company. And one of the first clients was a company in Birmingham called Barnett Ravenscroft Wealth Management, who asked me to make a documentary about investing, and particularly passive investing. That I found that exercise fascinating. I mean, I was very skeptical, believe it or not, about passive investing, I came to it with a completely open mind. But to be honest, Abraham, was blown away by the wealth of information and the evidence, the peer-reviewed, time-tested academic evidence that there is out there about how to invest. And just shocked, really, that most of us do completely the opposite to what the evidence actually says we should be doing. Not only that, worse still, we are actively encouraged to do so by the fund management industry, and alas, sadly, by some financial advisors and investment consultants. And that's briefly how I got into this. And I just find this subject so fascinating, but also so important, that I now focus pretty much 100% of my working life on it.
That's incredible. And you came, on my radar a couple of years ago when you released, this your video series on index investing.
Yeah.
Talk a little bit about that experience of going around, the country and also internationally, interviewing, academics, thought leaders in the investment world. Talk a little bit about how that experience in the background. And how you came to the limelight, from the financial service industry point of view.
Well, I'm not sure about the limelight, but I'm hovering, murking in the background somewhere still at the moment. A lot of people say, it's funny, Abraham, say, how have you managed to speak to all these Nobel Prize winners, all these really distinguished people in the industry, Jack Bogle, David Booth, and so on. And to be honest, what I found was that it was actually remarkably easy, because these people have been devoting their lives to researching this subject of investing, retirement, asset management, and so on. And they're actually quite happy when someone actually wants to find out about what they've been working on, what they've discovered. I remember just literally guessing Eugene Farmer's email address at Chicago.
Yes.
And getting an email back, send us questions. Send me questions, he said. So I thought, all right then. So I trotted out a few questions. Okay, come over. Actually, that was the response I had from William Sharp, for example, in California. Also in California, of course, is Harry Markowitz. Just had some really interesting times. I mean, chatting to Harry over a coffee in his local bagel store, and chatting to William Sharp. And he said, Robin, I really enjoyed this. I mean, I just wish more journalists took an interest in what we've been saying. So actually, I've actually found it remarkably easy to do. Jack Bogle, what a lovely guy he was, such an inspiration to me. went over, a couple of times to interview him. David Booth, Charlie Ellis. These are really, essentially, as well as being hugely bright people with brains the size of planets, they're actually really good people who genuinely want better outcomes for investors.
Thank you for that. That's very useful. So let's talk about your book. So again, congrats on the book, Invest Your Way to Financial Freedom. And this book, my understanding is it's meant for, people who are still at the very, at the early stage of investing, but I may be wrong, so correct me. So tell us a little bit about, the book and why you wrote it.
Well, first of all, I am hugely grateful to Ben Carlson, who I've actually known for several years. First met him at a conference out in the US a few years ago, and we sort of kept in touch. He wrote a book. Largely for entirely, in fact, for the US market, particularly aimed at younger people, to try to encourage younger people to get into good financial and particularly investing habits. He was then approached by Harriman House to say, the publisher, which I'm sure you know of here in the UK, to say, really like this book, British investors, young Brits need to hear about this message as well. Can we produce a UK version? Can you think of someone to work with you on it? And Ben said to me, I was the first person he thought of. I'm sure you would have been the next on the list, Abraham. I was most honoured. To do it. And so, what I did was you know what they say about the Brits and Americans? We're a common people divided by, two people divided by a common language. So, and so a lot of the kind of language had to be sort of changed. Some of the sort of Americanisms needed changing, but most of all, I wanted to focus on, the specifics of investing here in the UK, the various types of products that you can invest in the UK, and particularly the tax regime in the UK. Maybe we'll get onto this when we actually talk in more detail about the book, but I really think tax is something that people just don't think about when investing, and actually it's a really, really important consideration.
So one of the things that caught my attention in the book is this concept of the investor life cycle.
Yes.
And you draw an interesting contrast in the book between where Ben is in his sort of financial life and where you are. Talk to us a little bit about that.
Yeah, well, what we've really tried to do in this book is not complicate things any more than they need to be complicated. We've made it as simple as possible. And one of the most simple lessons for people to learn is that time is their friend. As our friend Jack Bogle used to say, time is your friend, impulse is your enemy. And the great advantage, I tell my kids, I've got a 21, 23-year-old, I say, you've got all this time on your hand to invest. You don't know what a massive advantage that gives you over the likes of me, for example, who has sort of much less flexibility. And also over professional investors who have to make who have to justify their existence all the time. They have to be beating the market over very short time frames and so on. So it makes it look as though they've got skill and so on. But the most important thing investors can do is to get started. If you're not investing today, get investing. And a lot of people say, oh, Robin, that's a really irresponsible thing to say because the market might crash tomorrow. And there's lots of stories at the moment, actually quite scary, some of them. There's this Evergrande situation in China, for example, and there's certainly been huge speculation in the Chinese housing market. In fact, housing markets all around the world have been sort of very inflated over the last few years. Prices have been going up, and particularly over the coronavirus period. But what I'm saying is, well, don't worry, just put 50 quid in today, put £100 in today. And if the market goes down 50% tomorrow, well, you've only lost 50 quid. And look, if you've got time on your hands, you're going to make that up in spades in no time. So the sooner you start, the better. And the more that you can put in your 20s, and indeed your 30s, the less you've got to put in your sort of 40s and 50s. And, I've got to a stage now where, I'm having to actually put away quite a lot of money. I mean, I was actually very sensible. Things went a little bit awry in the middle, but I was very sensible as a young man, very responsible, putting money into my pension, and that gave me a brilliant head start. But I'm now in this situation where I'm having to invest quite a lot of my income. My wife is exactly the same, to sort of catch up to where I should have been if I'd been doing that consistently throughout. So that's the investor's life cycle, and the earlier you can start, the more of the heavy lifting you do in the early years, the better.
Now, a word from our sponsor. Nikki Heaton-Jones is the Managing Director and the Chief Investment Officer at Betafolio, the high-tech, low-cost, discretionary model portfolio manager. Typical model portfolio service costs about 36 basis points. That's in addition to the funds, the platform, the advice fees. Tell us a bit about Betafolio's view and approach on fees.
Well, I don't think anyone that knows us already, Abraham, would be surprised to hear me say that in a nutshell, MPS fees are too high. If you include the fund charges and the platform fee that you already talked about, we get close to 1%, I think, on average for a lot of retail clients. And that's before they start paying for the financial plan, which is the part of the service that will ultimately add the most value for them in their advisor relationship and experience. My view on fees and Betafolio's view on fees is that they have a real impact on client outcomes that needs attention. And that's why we're building a scalable solution with technology that will allow us to keep costs low. And I think we also should consider the impact of these fees on advisors' businesses too. Advisors need to make a profit from their work. They need to have a viable business, and their cost bases have been rising because of regulation, and the more cost they have to pass through to their clients for overcomplicated services in turn puts pressure on the advisor's own fees and ultimately makes it not possible for them to run a good business. So fees are really crucial, and I'm really happy that we're in a position to be having a positive influence on the trends in the market.
Good stuff. Thank you, Nikki. I'm always fascinated by this argument of that you alluded to, this point that you alluded to about, people in their 20s or 30s, even 40s. I will go as far as saying even 50s, worrying so much about, potential market you know, a huge market correction, let's call it.
Yeah.
I hate that phrase, right? Because you assume that the market was wrong.
Exactly.
So then it corrects. You know, let's say a temporary decline in the capital market, as my friend will say. You know, because I can understand why somebody in their 60s who's maybe approaching retirement in the next 5 years might be already in retirement, might be worried about you know, a decline in the capital market, which is you know, always invariably you know, bar 1 or 2 exceptions I can think of in the last you know, 200 centuries, sorry, two centuries, a temporary thing, right? If you're in your 30s and 40s and even 50s, and you're looking at you know, a 10, 20, 30 years of accumulation in front of you, shouldn't you be pining for a market correction?
Absolutely, absolutely, you should. And in fact, you know, my kids just think the stock market only goes up, because, you know, I've encouraged them to sort of invest in sort of recent years in Vanguard life strategy funds. Just give a little name check to our friends at Vanguard there. It's pretty darn good product for young people to be investing in. And they think the market should be going up. I tell him not to. My son goes on there to check how much he's made, and you know, I have to tick him off for doing that. And actually, you know, it would be better, yes, if for them, if markets fell, you know, just as it'd be good for young people if the housing market could, you know, fell 10, 20%. Yeah, we really shouldn't be worried about these things. And look, it's very easy for, you know, a wizened old hack like myself to say that, because I've you know, been through all these sort of crashes and corrections. I mean, I remember at university, you know, being at university in '87 and hearing about, you know, what a horrendous decline that was, and obviously the sort of tech crash 99, 2001 to 3 was pretty horrendous as well, and of course the global financial crisis. But what we've learned from all of those things, and indeed all of the crashes throughout history, including 1929, you know, even if you'd invested the day before the crash, you know, if you had time on your hand, if you had time on your side, rather, if you had a long-term horizon, then it really didn't matter. And fair enough, don't suddenly commit a large sum to the market. That's when it can get a bit hairy. You know, and if you're worried, well, just, you know, put in. It's the most basic thing investors should be doing is putting money away each month on a regular basis, automatically, just going out without them even thinking about it on a one day each month. And if you're lucky enough to come into some money, you know, or a small inheritance or whatever, then just say, right, I'm going to put in like 10,000 this month, and then 10,000 next month, 10,000 the one after, and so on, rather than just committing, you know, a large chunk to the market in one go. But if you're patient, you know, the long-term historical data is overwhelming. If you're diversified, you're patient, you're disciplined, you're going to be fine.
And I almost feel like we have to qualify this, because, you know, so you're talking about this idea of time diversification, feeding your money, spreading your money, you know, into the market over time, right? I almost feel like we have to, you know, and this idea that, you know, the long-term data is on your side, long-term evidence is on your side. But I always feel like we have to qualify it, that what we're talking about, of course, all of this works if you are investing in a globally diversified, low cost index fund, which you're a big fan of, I know, right? It doesn't quite work, right, if you are picking stocks, right? Or even entrusting your life savings into the hands of a single manager, like, for lack of any other name to drop, Neil Woodford, which I had a podcast about a few weeks ago, because then you cannot rely on data, on the overall capital market to do the heavy liftings, because in that regard, you're moving away from that wisdom that is embedded in the capital market. Am I right in thinking that?
The way I like to look at it, I mean, you referred to this earlier, Abraham, in this conversation about, you don't like the idea of a market correction, because in a sense, the market is always right, the price is always right, if you like. Now, I sort of agree with you on that.
Say I'm wrong. It's okay. I'm used to being told.
The way I like to look at it is the stock market. And by stock market, I mean the global stock market, not just the FTSE all share or whatever, the global stock market is an amazing supercomputer. And it's got this data going in at literally, tens, if not hundreds of thousands of times every second. Because that's what's happening with this high frequency algorithmic trading and so on. You've got some firms which are trading literally, thousands of times a second. I mean, it's crazy. And every time somebody trades, they are expressing an opinion as to what an asset is worth, whether it's a stock or a bond or whatever else. And that's just a basic fact of the stock market. I mean, if your listeners and viewers want to read about it, it goes back to a paper by a French mathematician called Louis Bachelier around 1900, who came up with this well, it's not even a theory. I mean, this is how the stock market works. It's like Brownian motion. You cannot work out from one day to the next whether the market is going to go up or whether it's going to go down. It is just a random walk.
I like your analogy about a supercomputer. It's indeed, Ben Graham, who said that in the short term, the market is a voting machine. It's tying up, which firms are popular or unpopular. But in the long run, it's a weighing machine, basically assessing the substance, the value of a company. I really like that. One of the things that you touch on in the book is the idea of diversification. You talked about diversification of time, right? But also diversification of investment, the asset allocation of the investor. And I'd always wondered what we should be saying to young people. On the one hand, they've got time on their hands and not a lot of money. They're going to deplete that money over time. So they've got the power of time time diversification on their hands. But we do, so my natural inclination is to say, just put it all in stocks, right?
I know.
Find a globally diversified index fund, 100% equity, put it all there. That's what I do. I'm not that young anymore. That's what I do for my kids. A little bit of, small, value exposure in there, right? actually a lot for me, but anyway, it was it was counting. Just put it all in a globally diversified equity portfolio.
Yeah.
But then
Mm.
we know that these people, they haven't got a lot of investment experience. You talked about your son or your sons who are your children who are, they've never known a huge market correction before, until probably the recent one, and didn't last very long. And there's the fear that they might be completely scarred for life. They take too much risk. I wonder what your thoughts are on this, and so therefore a more diversified portfolio. I wonder what your thoughts are on this conundrum.
I think the problem, Abraham, is that there is a lot of peer pressure on young people. They see their friends making money, whether it's on a penny stock, one of these sort of small lottery stocks, or maybe it's Bitcoin or Ethereum or something, and they just assume that they're going to be able to do the same thing, and of course the financial media, and I speak as a journalist, and I'm hugely respectful towards journalists, but also very apologetic on behalf of the journalism industry, because I think financial journalism has actually, not done investors many favors over the years by concentrating on, the latest hot fund, the latest hot stock or sector or whatever. That is all just completely irrelevant. The iron rule of the markets, to quote Bogle again, is reversion to the mean. And because Bitcoin has done really well, recently or over the last, month or whatever, that's only going to make it more likely that it's not going to do quite so well in the future. I'll just take Bitcoin as an example. The best thing to do, as you say, is to just diversify your risk. We can't do anything about market risk. Markets will always go up and down. It's just the way markets are, and of course we get rewarded for that risk as stock investors. But what you absolutely can avoid is concentration risk, and it worries me that some young people are just massively concentrated in things which, and if I can just express an opinion here, are worth pretty much nothing. In other words, cryptocurrencies, or in individual stocks, which, who knows what might happen, what calamities might lie in wait for a particular stock. But if you're invested in the whole stock market, if one stock goes belly up, what's the big deal? You've got 999 others or whatever.
Yeah, and I don't know how we should be, speaking to people about this. I have to be honest, because on the one hand, you got all these cryptocurrencies, Bitcoin, all this, individual trading. I mean, we saw what happened, during the lockdown with the, US platform, Robin Hood, where people were reportedly, obviously seated at home during the pandemic and trading, stocks on margin, on credit. And again, I wonder what your thoughts are. There's a part of me that says, well, these are young people. Well, for these young people, perhaps the answer isn't to say to them, don't do it, right? It's all, it's all going to blow up in your face, right? We're telling them, what is obvious. Rather, we let, when is the right time to get all these things out of your system? You talked about how you started reading stock tips in the pages of newspapers. I worked, in the early days, I worked into a stock brokerage firm to to ask for a job, and traded stocks in the very, very early days, in my university days actually. But today, and then of course along the way people learn, right? They realize that this is just foolhardy, right? And when they have serious money, then they start to invest, hopefully not too late, right? So my question is, should we essentially let people get it out of their system, especially when they don't have money? Of course, there is the tragic case of a young man in the US who took his own life as a result of this Robin Hood trading thing. But overall, is the advice to younger people, say to them, well, look, don't do that stuff. Just put all the money in your retirement account, diversify, simple equity bond portfolio. Or actually, should we come up with, do you have a framework that says, well, your serious money, your long-term money, yes, absolutely, should your retirement savings should be in boring stuff like life strategy, right, and all that stuff, that actually deliver in the long run. And your play money thing, that you got money to play with, sure, knock yourselves out. It's going to blow up, but get it out of your system.
But this concept of people having money to play with. I mean, I'm wealthy. I mean, I don't consider I have lots of money to play with as such. And certainly when you're a student, I mean, for goodness sake, I mean, I was living on baked beans. I mean, at that age, I mean, I wouldn't have had any money to gamble.
You can trade on, I don't know, £100, these days. No.
Yeah. Well, you can, but it's gambling. It is essentially gambling, and I think what we're seeing now is online trading really taking over from sports gambling, sports betting, as a accepted sort of pursuit for sort of young people. I was shocked actually when my son was in the sixth form. He would say, Ben's bet £60 on Man United winning 2-0 or whatever at the weekend, and I'm saying, how can they possibly afford that kind of money to bet on outcomes of sort of sporting events? And when you're betting on stocks, all the known information is already in the price of the stock. So if you think that a share is going to be better than the market or worse than the market, you are diverging from the market view. You are taking a risk. You're taking a gamble, and the chances that you're wrong and the market's right are very very high. And what young people are essentially doing is they are betting on these stocks and cryptocurrencies. And as you say, trading among young people has been very popular during the pandemic when people had time on their hands. But look, we have seen an extraordinary bull run in stocks since the end of March or whenever it was last year. It was impossible not to make money, and these young people think they're geniuses. Well, they're not geniuses. They would have made even more money if they had just simply invested in a low-cost tracker fund. And my worry is that when things, head south, which, and I'm not predicting that they will anytime soon or, in the future or wherever, but, sooner or later they will do. And those people are going to realize, crikey, this trading business is a lot harder than I thought it was. And particularly with cryptocurrency, and this worries me, that rather like tulips, or rather like those kind of mortgage-backed derivatives, that spectacularly crashed to earth in 2008, people will suddenly realize, crikey, these things aren't worth anything at all. And I've got hundreds and hundreds of pounds invested in these, and they'll all be rushing for the exits. I'm actually really quite concerned about the knock-on effects of a crypto crash for the stock market and indeed the global economy generally.
I like this, the analogy, that you kind of alluded to earlier on. Don't confuse a bull market for brains, right?
Exactly.
For genius.
Exactly. Yeah.
In wrapping this up, a lot of the listeners to this podcast will be financial advisors who generally don't advise young people, right? Because, on investing, because they rarely have the money, to do that.
Yeah.
But of course, their clients have children.
Yes.
Many of them are drawn into conversations about how to invest for clients' children, and perhaps ultimately what happens to the legacy that their clients might leave. How do you think our profession should be, what should we be doing? How should we be engaging? Should we even be engaging children of clients and younger people generally about money?
This is a hugely important subject. I was actually talking to a financial planner in Derby actually about this only yesterday, and he has a study group of other like-minded, evidence-based financial planners around the country, and they're talking about the same thing. How do we make financial planning relevant and helpful for people other than those in the top 5% or even the top 1%, and people generally who are 40, 45 plus. And I absolutely sympathize with financial planning business owners on the commercial point. You've got to make the numbers add up. You can't offer too many loss leading services, if you like. Having said that, young people today are your clients of tomorrow. And so what you need to be doing is you need to be engaging with those people at an early stage. And even if they're not fee-paying clients of yours, as long as you're on their radar as people who genuinely have their interests at heart, that will stand you in good stead for the future. Personally, I think that although it's perfectly possible, just by reading, this book, that you can do it yourself, I would still encourage even young people to just spend an hour, 2 hours, 3 hours with a financial planner, just to talk it through, just to make sure that they're not missing a trick, particularly on the tax issue I mentioned earlier, for example. So what I would like to see is firms offering like a one-off service, as a sort of let's get you started service for young investors, and then just come back to them in 5 years' time and say, how are you getting on? Can we help you? Can we show you about cash flow modeling? Can we give you a proper, holistic financial plan, for example? So I absolutely think that advisors should be doing this. And finally, Abraham, if I could just finish by making a little bit of a sales plea, if you like. What I'm really hoping is that financial advisors actually buy this book for their clients, and indeed the publishers are open to customized versions of the book, where you could have a foreword by the founder of the firm saying this is what we encourage young investors to do, because as you say, clients who are 50 and 60 plus, they have clients, they have children in exactly this age range who would massively benefit from reading that book.
No, fantastic stuff. Look, we've got a couple of copies for this. I like the idea of firms, white labeling, if you like, or whatever you want to call it. I've actually seen this, not particularly for your book, but in other engagement with firms where they've done what you're talking about with a particular book, but I like that idea that firms can then give to their clients who can, ideally, also pass it on to their children, and to the extent that, your name, as the advisor, is, you're linked to that positive impact.
Yeah.
I think that's great, absolutely. So if you can tell us a little bit more about how to get in touch with you if they want to do that.
Of course. I'm on Twitter. You may have noticed. At Robin J Powell is my Twitter handle. I'm on LinkedIn. Happy to give you my good old-fashioned email address, powellrj@me.com. powellrj@me.com. Otherwise, just get in touch via the Evidence-Based Investor, my blog.
Fantastic stuff, Robin. I wanted to ask, this would have been a great way to end the podcast, but I wanted to ask you to talk very briefly about the evidence-based advisor, because I know that after a couple of years ago, you engaged on this project to get more involved, with making financial planning more accessible. So I guess we can refer to you in a way as a financial planning business owner. But tell us a little bit about that.
Yeah. Okay. As a journalist, the last thing I expected to do was to end up working with a financial planning firm. But that's exactly what I'm doing. And I suppose I spent sort of 7 or 8 years talking about the problem, and then realizing that I actually really, really wanted to be part of the solution. And so a few years ago, I got together with Rock Wealth, who are absolutely brilliant financial planning firm based in Cheltenham. And together we have set up a separate company, Evidence-Based Advisors, and that enables people to financial planning firms to trade as authorized representatives of Rock Wealth, and we provide them with the IP. With all the content that I'm largely responsible for, videos, video documentaries, blogs, and e-guides and newsletters and so on. And there's back office support, there's locum support, there's help with portfolio management through the excellent work that you and your colleagues are doing at Betafolio, Abraham. And help with advisor technology as well. So yeah, if there are any financial planning firms that would like to work with us, then please get in touch with me about that. I'd be happy to put you in touch with all the right people at Rock Wealth. I mean, this particularly, I suppose, applies to smaller firms who are, just really sort of setting out on the journey. And also people, and Abraham, I hear from these people all the time, working with firms and just saying, I don't like it here. I don't like my employers very much. I don't like the ethos. I don't like all the emphasis on sales. I just want to focus on really adding proper value. Never mind the BS, if you like. I just want to be honest with people about how investing really works, and help them to lead, better and more fulfilled lives. So if you want to leave your firm, life's short. You've got to do what you want to do. Why not come on board with us, and we can help you set up your own financial planning firm. We've got firms now, 5-6 firms around the country, but we're looking to to open up in more areas. So again, please get in touch.
So I'm really fascinated by this, and obviously because I know a little bit about what's going on. We see these firms, we see some of these firms as you open up, because you guys use our portfolio and timeline technology as part of the proposition, and so the typical again, is there a typical approach? I want to understand a little bit about how this works. So a financial planner who's been working within a firm and then decides to go out on their own for whatever reason, because they want to be in control of their own destiny, they come to you and you offer them this platform to launch the service.
We can pretty well do everything for them. We two things. We need them to be really good financial planners and to very much share our values about in investing and putting clients first. And we're also fee only as well, or fixed fee. So that's a really important part of our ethos. We're also very big, by the way, on ESG. We're not pretending that ESG is massively going to outperform. I'd be very surprised if it did, but we do think that it's very important that investors should be investing in a sustainable way, and that advisors should be encouraging them to do so. So that's really important. The other thing is they need to be entrepreneurs. They need to be able to set up and run their own businesses. We can't do everything for them. Obviously, we will help them. So that's what we're looking for. Talented, entrepreneurial financial planners.
Good stuff. Robin Powell, thank you very much for your time, for your wisdom. I've really enjoyed our conversation today. And to all of our listeners, thank you very much for listening to the podcast. Invest Your Way to Financial Freedom is the book. And of course, you can find it on Amazon, and where where good books are sold.
Exactly. It's also available on the Harriman House website as well. So, and there's a Kindle version too. So, in fact, Harriman too have a system where if you buy the physical book, you get the digital one free anyway. So that's worth having.
Good stuff. Thank you for your time, Robin. Enjoyed our conversation. Take care.
And you, Abraham. It's been a pleasure.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together, led by my producer, Hannah Dickinson. Thank you very much, guys. I'd like to thank our sponsors, Timeline App, the retirement planning software, and Portfolio, the high-tech, low-cost, flat-fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.